Hello and welcome to the lecture for the first part of Chapter 11. So in this section of the lecture, I'll talk about accounts payable, the current portion of long-term debt, and notes payable. And then we'll get into payroll. I'll talk a little bit about payroll and payroll taxes, go over some journal entries. And then in the next lecture for Chapter 11, I'll talk about payroll accounting systems, fringe benefits, and lastly, contingent liabilities. So to start with, let's talk about some important definitions. So first of all, the creditor is the entity making the loan. So it's the bank, it's the supplier, it's the lender. The debtor is the person incurring the debt. So if you go buy a car, the car dealership is the creditor and you are the debtor. Okay. A current liability is any debt that is required to be paid within the upcoming 12 months. So it's not within the remainder of this year or next year. It's a moving 12-month window from whatever time in which we're reporting. So two things about that. One, it's a debt that falls due within a year, but it's also one that needs to be paid with current assets. So if the company's intention is to instead pay that liability with new debt, basically cycling through, then it would remain a long-term liability even if it's due within a year. So everything else is a long-term liability. Those would be like mortgages, 5-year notes. We'll talk about bonds in a couple of chapters. Those are all long-term liabilities. So accounts payable is a fairly informal kind of liability that is created when you purchase goods or services from other companies, usually a net 30 term. So you issue them a purchase order, they provide you with products or services, and they provide you with an invoice that is the basis for your debt. So the current portion of long-term debt is the portion of a long-term installment loan that comes due within the upcoming 12 months. So for example, if you have a mortgage on a building and you're making monthly payments, it would be the principal portion of the payments for the upcoming 12 months. And then of course we have short-term notes payable. Those are promissory notes due within the next year. If you remember in Accounting 201, when you talked about receivables, there were accounts receivable that are like trade receivables, and then there were notes receivable that are more formal. This is the same thing here. So we can have accounts payable, that's the informal amounts owed to your suppliers, but then there could be a note payable that is easier for the creditor to collect on, but more formal, signed document, that sort of thing. So a couple simple journal entries here. So when a company borrows money on the borrower's books, we'll debit cash, we're receiving cash, and we'll credit note payable. That's for a 90-day 15% note to First National Bank. When we repay the loan 90 days later, in this example, we'll debit notes payable to take that off the books. We'll record interest expense. And remember, the formula for interest expense is the principal times the interest rate times the portion of a year. So this would be 4,000 times 0.15 times 3/12. And then we credit cash for the 4,150 that represents our full payment of that loan. Now, also keep in mind that if it's at year end, if the term of the loan straddles the end of the year, we'll have to accrue interest in the first year and then record the interest for the portion that is accrued in the second year. So there are also what are called discounted notes, which are generally kind of a higher risk kind of lending, where you receive a lower amount than what you do. So the creditor is essentially taking the interest off the top from the beginning. So again, it's the same type of mechanism, but the journal entries look a little bit different. So in this case here, we borrowed $20,000, a 90-day discounted note is the term. So instead of receiving $20,000 in cash when we borrow that money, we receive $19,250, and the borrower records the interest right off the bat, okay? And we record that we owe $20,000. Later, when we pay that debt, is just simply taking the payable off the books with a debit and crediting cash for the amount that we're paying. A little bit different. So next, let's talk about payroll. That I can't think of a company that doesn't have payroll, so it just affects about all companies. So payroll is the amount paid to employees for their services. And there are two types of payroll. There is salary, so that's a fixed amount per month or annually that's paid to generally managerial and administrative staff. And then there are wages. Those are hourly payments, so $15 an hour, $12 an hour, that sort of thing for more hands-on labor. In the state of Washington, we use slightly different terms than that. So we use exempt and non-exempt. And it refers to that last point there, being entitled to receive overtime. So in the state of Washington, salaried positions are called exempt, meaning you're exempt from having to pay those employees overtime. So if you're an assistant manager at a clothing store, you may be salary. That would mean you're exempt from being paid overtime, so you could work 50 hours, you're still paid the fixed amount per month. You're not paid any overtime. Whereas if you're an hourly employee, then any hours, then you're considered non-exempt in the state of Washington, and any hours worked over 40 hours in a calendar week is paid at 1.5 times the rate of regular pay. So there are different rules about in the state of Washington about who can be salaried and who can be hourly, and of course there's companies that try to cheat that, so it's good to be aware of. One of the rules in order to qualify to be exempt is that you're a manager or a supervisor. In the state of Washington, you have to manage or supervise 2 or more employees to be considered exempt. You could be a creative person, so an artist or a copywriter or something like that, or a professional like a CPA or an attorney or a dentist or something like that. So you wouldn't be in a supervisory role, but you would also be considered exempt. Everyone else is considered to be non-exempt, which means they get paid overtime. So when I mentioned earlier that some companies do fudge this a little bit to try to save money, it's a very serious thing to do. If you get called out for that, or the government comes after you for that, you end up having to pay a very big penalty and then pay all of that back over time as well. So top earnings is total earnings, is gross pay. So it's the number of hours you work times your gross rate of pay. But again, any of you that have had jobs know that if you work 40 hours for $10 an hour, $400 is not the amount on your paycheck. It's the amount of gross pay, but there are deductions. So gross pay less those deductions equals your net pay, the amount that's actually on your paycheck. A couple of different things that are deducted from your paychecks. We'll talk about each. So federal income taxes are withheld from an employee's paycheck, and the company sends those to the IRS on that employee's behalf with information with their social security number so that they know who that's being sent for. The purpose of that is if that wasn't withheld and the government just expected everybody to be saving enough money that at the end of the year they could file their tax return and pay their taxes, they know that a lot of people wouldn't have that money. They would spend it on other things. So this is a way of kind of enforcing that saving money to be able to pay your taxes at the end of the year. So the employee communicates their status, both marital status and how many allowances they have, basically how many exemptions they have, on a W-4 form. So that's then used by the company to look up on a chart and find out how much it should be deducted for that person's pay. And yeah. The other type is the FICA, which is Federal Insurance Contribution Act, and it comprises 2 programs. One is Social Security, which is 6% of gross pay, and it's up to a limit. It's capped, and once you are over that limit, they no longer deduct 6%. And then there's Medicare, which is 1.5% of gross pay, and there is no limit on that, so it can be as much as you earn. I'll talk a little bit about more of that in a minute. Then there are potentially other deductions. So that may be contributions for medical benefits, it might be union dues, it might be charitable contributions to United Way. A lot of companies do that. So it could be a whole variety of things. It could be retirement savings, your deductions for your 401k plan. So it would look like this for an employee. So this employee earned $1,462 either through hourly wages or their salary. That's for a week. And so we deduct 6% of that amount, $87.72 for Social Security. We deduct $21.93 for Medicare. We look up on the chart based on their marital status and the number of allowance they have, and we figure out that we should withhold $263.40 for federal income tax. And then this person is participating in a retirement program, so we deduct $20 for that and $5 for charitable deduction. So we subtract all of those deductions to come up with a net pay of $106,395. That's the amount that will be shown on their paycheck. So I just talked about the deductions that are shown on the left side of this slide that come out of the employee's check and the minimum required are federal income tax, Social Security, and Medicare. The business also has to pay employee payroll taxes on top of what's deducted from the employee. So the amount deducted from the employee, that's forwarded on to the federal government. The company is just a pass-through for that. But then the company has to pay taxes above and beyond those amounts that are deducted. They have to match whatever is taken out of the employee's check for Social Security. So the employee pays 6%, the business also pays another 6%. The same thing with Medicare. We deduct 1.5% from the employee's check. The business matches that 1.5%. And then the business has two additional taxes they have to pay on employees that are not deducted from employees' checks, and that's federal unemployment tax and state unemployment tax. That's FUTA and SUTA. Those generally add up to 5.4%. And again, it's the business that pays that, not the employee. So if you hire somebody and they're working for you at $10 or say $15 an hour for 40 hours, they cost you more than that $600 of wages because you also have to pay business-related payroll taxes on that. So that's all for the first part of this chapter. I look forward to talking to you again when I lecture on the second part of Chapter 11. Thank you.